In the past few weeks, I imagine many watching this video will have lost a solid chunk of money. With the Fed talking about raising interest rates and tapering quantitative easing, we watched all three major indexes fall quite a bit, with the Nasdaq getting hit the hardest. Today, I want to explore why this correction in prices is actually a good thing and how we can all come out on top in these uncertain times. Hey everybody, and welcome back to Dollars and Cents, helping you make sense of making dollars. First, we need to take a step back and look at what's actually happening. Since this is a really complicated subject, I'll try and make it as simple as possible, but at the cost of some nuance in this discussion. So, let's go. As the pandemic loomed and forced many businesses to shutter their doors, some permanently, the US government and the Federal Reserve decided to intervene by trying to prevent the total collapse of business in the US. And things got experimental. The Fed rapidly expanded its balance sheet by buying hundreds of billions of dollars in Treasury securities and cutting short-term interest rates to near zero. This meant the US economy got much-needed liquidity in markets, and both companies and individuals could borrow money at ultra-low interest rates. What we've seen over the last 2 years are the effects of this intervention in the private and public markets. In the private markets, we saw $643 billion go to funding new businesses. That's a 92% increase from 2020 and a 543% increase from 2019. On the public side, we witnessed all three major indexes run up too. The S&P 500 shot up nearly 100%, while the Nasdaq ran up over 110%. This charge was led by the Big Five, which make up over 40% of the Nasdaq index alone. But inflation is on the rise now too, standing at 7% as of this video. Now, with most of the world being reopened from the lockdowns and businesses are starting to run again, the Fed is looking to end the programs it placed to bolster the economy, and its plan is to raise interest rates and taper much of the asset buying. Ultimately, this signals an end to the so-called free money, which led to the massive faltering of many of the high-growth names from the last 2 years. Look anywhere in the tech sector and you'll find companies that have fallen 35 to 50 to even 75%. But is this really a bad thing? Could this actually be a really good thing for investors, not only as a monetary opportunity, but also as an educative one? If anything, when stocks go down, you should be happy. Many people quote Warren Buffett and other famous investors, but I have a different frame of reference. It's like you go into a store and you have your heart set on a shirt that's just too expensive. You leave, but when you return another time, that same shirt is 50% off. And that's a great price, so you buy the shirt. It's now worth 50% of its original value, with nothing about the shirt having changed. And I think that same logic can very easily apply to stocks. Buying cheap stocks is like shopping on sale. What better way to illustrate this than with the example of Netflix? Over the last few months, the popular streaming site has dropped nearly 50% of its stock price. Why? The company's most recent earnings report stated slower than expected growth. Remember, Netflix crushed every earnings call during the pandemic. It's not that growth fell, but just slowed down. Fundamentally, nothing has changed with the company itself. With the rise of interest rates and this slowed growth, Netflix is trading at pre-pandemic levels. In fact, it's trading at 2018 highs. Despite the world's gradual reopening and the easing of lockdowns, Netflix is still able to add millions of subscribers every quarter. It's like that shirt that was too expensive before, but is now on sale. Its value is different, though the shirt itself is still the same. Really, you can look everywhere and find deals just like this. You can also apply the same logic to the companies you own. I do it with my own portfolio. For instance, Corsair holds one of the largest positions in my portfolio. I think the company will benefit from several large incoming tailwinds over the next few years, so to me it's extremely valuable. Personally, I started buying shares around the $35 range, and have averaged all the way down to the share price, which is now under $20. My cost basis is right around $28 per share. And sure, seeing that 30% loss is painful, but at the end of the day, I believe Corsair is worth far more than what I'm paying today. I also wouldn't mind if Corsair continued to fall even lower, say even under $10 a share, and I would be buying so much more, as long as nothing fundamentally changes about the business. Again, the shirt is on sale even though the shirt is still the same. But that's why it's also a good idea to own good businesses. When you buy a stock, you need to remember that you're becoming a partial owner of the business. Its success is your success, and its failure is also your failure. If we take a look in history, we can see clear examples of this back in 2008 and the tech bubble of 2000. Specifically, in the 2000 tech bubble, we saw every kind of company come out of the woodwork to go public. They weren't all successful, making money, or maintaining a sustainable business model either, but at the time it didn't really matter. Everyone was only looking forward to the next big thing in technological advancements. Nothing exemplifies this more than Jim Cramer's list of winners of the new world. This list was supposed to comprise the best companies that would dominate the new century. 22 years later, only 2 of these companies are still publicly traded, and only VeriSign passed its 2000 all-time high. All the others have fallen 75% or more once the bubble popped. Some companies from this era vanished altogether. Pets.com, Webvan, and The Globe didn't make it. Then there were those who absolutely excelled, later dominating the world, like Amazon, Microsoft, and Apple. Many other companies are still around, like Cisco, Intel, and IBM, but have struggled in recent years to pass those 2000's all-time highs. These turned out to be solid investments for the people who held on even at rock bottom, because the companies are good businesses. Again, that's why it's important to own companies with good, sustainable businesses. They can probably weather a financial storm and turn out alright. Companies today that I think can do the same are PayPal, Spotify, Square, and Dropbox. Yes, I know recently they've been getting crushed, but I believe they have good management, sustainable business models, and provide services that'll see them through this. I think they'll continue to be major players in their respective fields. And there's one company that I've made no secret of that I'm excited to see fall, and that is Tesla. Tesla is literally changing the world. It's got a solid production ramp, decent financials, and is just one of the better car companies around, and I believe is poised to dominate a future where electric vehicles are everywhere. And if, let's say, over the next year, Tesla's stock price falls 90%, I would absolutely be a buyer. I just think it's a really good business. But it's important that we need to be able to recognize what makes a business good. I personally believe that besides a good business model and great management, cash flow is one of the most important parts of any good business. Look at what the company is actually doing with its money. If a company manages to change the world in some way or another and still turn a profit, there's a strong chance that it'll be able to survive an economic slowdown or a market downturn, and they'll certainly be better off than the companies who generate little to no profit at all. And that's also why I chose PayPal, Spotify, Square, and Dropbox to mention earlier. They were all generating free cash flow before 2020. Plenty of companies have gone public in these last 2 years that have only lost money, and some companies lost money all the way up until 2020, with no bigger example than Shopify. It's for this reason that you should be incredibly choosy and careful about what companies you invest in. For me, cash flow is a good indicator of a good company. Remember, chances are that companies which lost money before the 2020 boom will, at some point, go back to losing money in the future. So, is this the end of growth? Well, I don't think so. If you have a solid company with good free cash flow and a sustainable business model, even if the economy should struggle for a while, the company has a fighting chance to survive and rebound. Amazon, Apple, Cisco, Microsoft, and plenty of others did when the tech bubble burst in 2000. That company can grow again and possibly even better than it did before. Of course, nothing is guaranteed. There will be fatalities, some companies that lose no matter what, but that's all a part of investing. Really good investors learn and adapt. And that's all I've got for you in this video. Do you think that the growth in the economy is ending? Which companies do you think will quote-unquote go on sale next? Leave your thoughts in the comments section below or join my Discord where we can talk more. Until next time, I will see all of you in the next episode of Dollars and Cents.